Thinking about trading but don't know where to start? This video is your ultimate starting guide to success as a trader. From market analysis to risk management, this video breaks down the basics of trading in simple steps. In less than 10 minutes, I will walk you through the essentials so that by the end of this video, you'll feel empowered to start your trading journey. Beginner or looking to enhance your skills, this video is designed for you. Are you eager to learn how to trade futures? So let's get started. In this video, we'll cover the basics of futures trading on candlestick charts and help you get started with confidence. So what exactly are futures? Simply put, futures contracts allow traders to buy or sell an asset at a predetermined price on a future date. This is useful for hedging against price fluctuations and speculating on market movements. Think of them as bets on how prices will move in the future. Now, why should you care about futures trading? Futures markets are often more volatile than spot markets. This means they can offer larger potential for profits or losses. There are various types of futures contracts available, including commodity futures like gold, oil, currency futures like Euro USD, index futures like ES futures and Nasdaq futures. Nasdaq futures are commonly called as NQ futures. E-mini S&P futures are commonly called as ES futures. Each type has its own characteristics and trading strategies. Chart analysis is the backbone of technical analysis in futures trading. It involves interpreting price movements and trends to make informed decisions about buying or selling assets. By mastering candlestick patterns, identifying trends, understanding key levels, utilizing moving averages, and analyzing volume, traders can gain valuable insights into market behavior. Remember, practice and patience are essential to becoming proficient in chart analysis. Now let's take a look at some basic concepts in futures trading and talk about trading using futures charts. There are several types of charts used in futures trading. The most common ones include candlestick charts that show the price movement over a specific period, including open, high, low, and close prices. Bar charts are similar to candlestick charts but simpler, showing only closing prices. Line charts draw a smooth line connecting closing prices. These are great for long-term trends. Common indicators include support and resistance, moving averages, relative strength index, and VWAP. Support and resistance levels. At these levels, prices have a tendency to bounce back from or move away from. Moving averages. They smooth out price data to help identify trends. Relative strength index, or RSI in short, measures the speed and change of price movements. VWAP is a measure of the average price at which a futures contract trades over a specific period. It takes into account both the volume and price of each trade to give you an accurate representation of market activity. The moving average convergence divergence, or MACD indicator, is a popular momentum tool used primarily to analyze trends in financial markets. Unlike some other indicators, MACD is not typically used to identify overbought or oversold conditions, but rather focuses on trend direction and strength. On a chart, it appears as two lines that oscillate without upper or lower bounds. When the two lines cross paths, they generate trading signals. These tools help you identify trends, potential reversals, and risk levels. Now that we've covered the basics on futures and chart analysis, let's discuss some beginner-friendly trading strategies. Trend following strategy, range trading strategy, and scalping are effective methods for beginners to get started. So what is trend trading? Simply put, trend trading involves identifying and riding the momentum of a price movement in a market. It's like following the crowd, but smartly. In futures trading, trends can be identified by analyzing charts, looking for patterns, and understanding the underlying drivers of the market. Here is a live trade showcasing trend trading strategy in action.
Target filled.
Range trading is a strategy that involves buying and selling within a specific price range. It is based on the idea that markets tend to oscillate between two levels, support and resistance. By identifying these levels, you can profit from the natural fluctuations in the market. This is a live trade showing range trading strategy in action.
Target filled. Order filled. Target filled.
Scalping is a
Order
trading
filled.
strategy that involves making multiple small trades in a short
Target
period,
filled.
typically within a few minutes. The goal is to capitalize on small price movements and lock in profits. But
filled.
here's the thing, scalping is not for the faint of heart. You need to be able to handle
Target
high-frequency
filled.
trading, tight stop losses, and significant market volatility. These strategies can help you get started in futures trading. Remember, it's always important to do your own research and develop a strategy that fits your trading style. Remember, practice is the key. Before risking real money, consider using a demo account. It lets you practice without any real consequences. Once you're comfortable, move on to real money trading. Always remember, futures trading is risky. Never invest more than you can afford to lose. Before you start trading futures, it's important to understand the risks involved. Leverage can amplify both gains and losses, so it's crucial to manage your risk exposure effectively. Risk involved in trading explained. Due to the high leverage nature of futures trading, speculators are more vulnerable to substantial losses, as even small price movements can result in significantly increasing their exposure. Futures market newcomers often find themselves unprepared to tackle the complexities of this type of trading. The primary risk in futures trading lies in its inherently unpredictable nature, where swift and significant changes in prices can occur, often due to the compounding effect of leverage when market dynamics shift suddenly. Proper risk management is essential for achieving success in futures trading. It's a vital safeguard against significant losses and a key determinant of long profitability. However, many retail investors and traders often fail to grasp the importance of effective risk management strategies. Risk management is crucial. Never use margin too high and always have a stop loss in place. Rule 1. Maximum loss on any given trade should not be more than 1 to 2% of your account size. Rule 2. Determine your risk tolerance and accordingly choose trade size and leverage. Rule 3. Never take on more risk than reward, aiming for greater than or equal to 1-to-1 ratio in all trades. Finally, let's talk about common trading mistakes to avoid. Emotional trading. Don't make decisions based on fear or greed. Overtrading. Only trade when there's a strong signal. Ignoring your stop loss. Always set a stop loss and stick to it. Adding to losing position. Learn to take losses. They are normal in trading. Revenge trading. Avoid revenge trades at all costs. Lack of a trading plan. You must have a plan for take profit and stop loss. To succeed in futures trading, keep these tips in mind. Stay disciplined, continuously educate yourself, and always risk manage your trades. Remember, trading is a skill that takes time to develop. Start with what you've learned here and keep practicing. If you found this video helpful, give it a thumbs up, share it with your friends, and make sure to subscribe for more content like this.